and turn that up just a touch. So good morning. Thank you for having me join you here today. It's a real pleasure to be back in North Dakota. It's been a while for me. As Don said, I work for CHS. I lead the agriculture business there. I grew up, a little bit about me, I grew up on a farm in southwestern Minnesota, corn, soybeans, cattle, and hog farm. My roots in agriculture, run pretty deep, and I've been committed to agriculture my entire career. Kind of a funny story, many years ago when I was growing up on the farm, one day our neighbor called my mom, and my mom picked up the phone and she said, Jan, your tractor's going across the field and there's nobody in it. Well, I was in that tractor. The issue was I was 7 years old. And she couldn't see me. So as I think about that, this is the 1970s, and that was my dad's version of autonomous tractors at that time. So anyway, it's great to be here, as I said, in North Dakota again. I spent almost 20 years of my career dedicated to durum wheat and pasta. Spent a lot of time trading global durum wheat for CHS, and then I also spent about a decade working for a dry pasta manufacturing business. So I've seen the change over time across North Dakota. Many years early in my career, I was buying durum wheat from places like Maddock and Harlow and Fessenden and Rolla and Rugby and Candu and Bisbee and out of the Grand Forks area here as well. And there was lots of durum that came from this country, and I think we'd have a hard time scurrying up much durum today in this country. Things have changed a lot more row crops, and things continue to evolve. And so what I'd like to talk to you all about today is that continued evolution and some of the big trends that are happening in agriculture. Hopefully you can gain some insights from that and some things that maybe I could suggest that you pay attention to over time and can anticipate what that might mean for the future of agriculture. Before we get into any of those forward-looking statements, the lawyers always send me with this slide, which I'm sure you've just about read every word of this, but we're going to make some forward-looking statements. Some of those statements may not turn out to be true, and so I guess we're not liable for those mistakes, or either that or the lawyers think I make a lot of mistakes, one or the other. Either way, there's the safe harbor statement that we always put up. Just a couple things. I'll talk a little bit about CHS, and it'll be with the vein of explaining to you what we're doing at CHS. And hopefully that kind of reinforces some of the trends that I talk about, because we're putting our money where our mouth is here, and trying to serve agriculture. So the purpose of CHS is to create connections to empower agriculture. We're very focused on the values of the company. We operate the company with a high degree of integrity. Safety is number one every single day. We in all of our operations and how we interact with all of you at our facilities and on your farms. Safety is always the number one priority for us. We try to run an inclusive company and look for a broad perspective of ideas and new ideas that help drive innovation and collaboration across the entire system of CHS and the entire cooperative system, from the farm to every area around the globe. And hopefully what you see, in this area in particular, where CHS has a pretty significant presence, is that cooperative spirit comes through. Because we work together for shared success in the communities on behalf and with everyone involved in agriculture. So I just thought I'd do just a backdrop of CHS and our values. You'll hear me talk about some of the strategies that we have as a company, and we really focus on customer and creating an experience that makes CHS your first choice. We focus a lot on growing market access. So you'll hear me talk a lot about international global businesses, trends, and how we try to connect the world back to the acre here in your backyards. And then the evolving our business in the changing environment. There's no question that the environment is certainly evolving and changing, and we're adapting to that as quickly as we can and appropriately to serve the needs of agriculture. And then transforming our company, constantly looking for ways to run a better company and be more efficient and do a better job for all of our owners. See if we get that to click. So, big trends in agriculture these days is you see energy and agriculture continue to get closer and closer together. And renewable diesel will be a significant part of our discussion here this morning as the primary example of that. But growing grains and grains going into the fuel supply to support sustainability globally is a major trend. With that, I think you should anticipate that U.S. agricultural exports of grains will continue to decline over time and be a smaller percentage of the global trade, simply because we're domesticating more and more of our production, and I think we'll do that faster than what we can innovate and increase yields and increase acres and those type of things. So the export markets you'll probably see that decline over time, but it will still be a very important price component of global pricing. Row crops continue to put pressure on other crops, and I think I'll show you some information, about a 20-year chart on wheat, for example, where wheat has experienced a fair amount of row crop pressure over the last 20 years, and probably will continue to see that as this demand for other crops that have more utilization for fuels will continue to put financial pressure on the returns of other crops. And then geopolitical disruptions around the world. Clearly, we've seen a lot of that lately. A couple years ago now, it'd be almost 2 years come February when Russia invaded the Ukraine. You've got the war in Israel and the Gaza Strip going on. You've got controversy on Taiwan and China. Just major things that happen that are disrupting the world. Weather patterns that shift production capabilities, either good or bad, and make significant shifts in the supply and demand. Weather that disrupts logistics, things like the Panama Canal right now, is first time that I've ever seen in my history, have low water conditions and difficulty getting ships through the Panama Canal, so it's disrupting global trade routes and trade flows, and where grain goes, out of this country. So those things are constantly happening. Those are the big picture items that I'd like to dive more into as we go out throughout our morning. Just a quick thing on CHS supply chain. We participate in a lot of different parts of agriculture and the supply chain, both to the farm and off of the farm. We operate a couple of fossil fuel refineries, one in Laurel, Montana, one in McPherson, Kansas, producing over 2 billion gallons of fuels. Our watershed area is really in your backyard here, of serving diesel fuel for your trucks and for your tractors, and all across the Midwest with those two facilities. Also, grain processing that we do in soybean crush at a couple of facilities of ethanol processing as well. And a canola processing plant in Halleck, Minnesota, not too far from here, is a kind of a portfolio where we try to add value to grains, and I'll talk a little bit about why that's significant portfolio of capabilities as we go out throughout the discussion. Infrastructure that supports that in pipelines and trucks and rail operations, vessel operations, barge operations. We try to provide those transportation services and connect everything. What we do is really supply chain and logistics to make sure that there's products available for all of you, and there's the capability to take the product away from the farm when you're ready to do so, and make that connect to the rest of the world. So the global market access, and I'll show a chart about where CHS operates around the world and why we operate around the world and how that connects back to the benefit of all of our owners. And then we tried to get further and further into the value-added components, things like production of nitrogen fertilizer with our CFN production economics that we have in our partnership in producing urea and other things that we do to connect the supply chain. CHS today, in agriculture, we do business in 65 different countries around the world, handle over 2 billion bushels of grain, 350,000 bushels of soybeans we process every day, and we're working hard, of course, with the trend in renewable diesel to do more of that type of stuff. The canola plant I referenced already, we produce a significant amount of ethanol at 2 large ethanol plants, but we also trade another 1 billion gallons of ethanol for others around the country as well. So we're deeply involved in this ag and energy connection that I referred to that's becoming stronger and stronger over time and is a pretty significant trend. On the fertilizer side, we're one of the nation's largest wholesalers of fertilizer. Distribute that really all across the country and across the world. We have fertilizer operations in South America as well, do a lot of global sourcing of fertilizer. Have a deep water port that I'll talk about towards the end in Galveston, Texas, that connects that import flow to all of you up here. And a number of different facilities to distribute that up and down the river system, as well as our CF nitrogen production in Port Neal, Iowa. And on the energy side, I talked about the 2 refineries, the 2.5 billion gallons of fuel. It's probably a little over 3 billion gallons that we actually trade and provide in our trade territories, and lots of pipelines and a lot of miles of distributing fuel to support all of that. And diesel is one of our biggest focus because that's what's used for the heavy equipment, and that's what we try to get the most out of our refineries every day, really focused on getting more and more diesel out of every barrel of crude every single day. So let's talk about the evolving landscape here and the renewable fuels changes that are happening, renewable diesel being the thing that you hear about the most. And I know up in this country, you probably spent a lot of time talking about soybean crushing because soybean crushing is expanding significantly all around the country, but in particular, we've seen a lot of activity up here in this region. Corn for ethanol and sustainable aviation fuel is what you hear the most about. E15 in 2024 will be approved in 8 states. We're certainly continuing to advocate for more E15, more year-round E15, to continue to add more ethanol blends to the liquid fuels pipeline, and I think that's an opportunity for continued growth. We've got a lot of corn production, and the corn yields continue to improve all the time. And it's a great source. On the sustainable aviation fuel, I think you'll hear a lot of people talk about trying to get ethanol to jet fuel. And that's something that the industry is working really, really hard at. It hasn't scaled as of yet, but I think there's some pretty significant opportunity for that to scale over time and be a source to consume more of the corn, the ever-increasing corn production, and turn ethanol into jet fuel. Jet fuel is a 25 billion gallon market in the U.S., and you can actually make jet fuel, of course, from soybean oil as well. You don't hear a lot about that because there's such a focus on renewable diesel with the soybean oil, and as I'll explain in a minute, there's a significant shortfall of raw material, number one, and processing capacity, number two. I find it kind of interesting if you think about the economics and the opportunity, because there's always going to be some sort of a mechanism that's going to have to support this transition. You hear a lot about LCFS and RINs and blenders tax credits, all of these things that support the production of renewable diesel, because simple fact of the matter is if crude oil is $75 a barrel and soybean oil is $200 a barrel equivalent, renewable diesel made from soybean oil is going to be a lot more expensive, so you got to find a way to deal with that mechanism. Another interesting thought that I've had around sustainable airline fuel is if you take, for example, a 737 airplane, it will burn about 1,000 gallons of fuel per hour. So take that plane on a 3-hour flight, you burn 3,000 gallons of fuel on that flight. Let's say that renewable, that sustainable airline fuel costs $3 a gallon more. And there's 200 people on that plane. It's $45 per person on the plane. It's not much more than a baggage fee these days. There's some mechanism, there's some way that this will get paid for in transition, and I think that it's interesting math to think about in a ever-evolving society that people are more and more committed and more supportive of a sustainable future for the planet. That $45 doesn't seem like that much when you think of it that way. So maybe it doesn't have to be a tax or a subsidy. Maybe it's just a really good marketing plan and support by people that are traveling in airlines that are willing to pay a little bit more. I think we all know that the ticket prices go up and down a lot more than $45. I spend a fair amount of time traveling to Florida for different events and stuff from Minneapolis, and that's a 3-hour flight, convenient to my example. And last year I think I paid a little over $300 for that ticket, and last week I paid $600 for that ticket. So that $45 seems pretty small at that point in time. So I think there's an opportunity for that soybean to cross over into that sustainable aviation fuel is the point, in addition to the renewable diesel market, which is really significant. Market is diesel fuel in the United States is a 60 billion gallon market. Biodiesel is, as many of you probably are aware, is a little bit more of a challenged market. It's not as storable. It's got some temperature constraints on it, and then I think as the renewable diesel market evolves, you'll see less and less focus on biodiesel. So I mentioned the LCFS. It started in California. There's 3 legs to the tax stool that really supports renewable diesel production. It's the LCFS, the blenders tax credit, and the RIN. And those 3 mechanisms working together to support consumption of renewable diesel in California is really where it started. And as it's moved into Washington and Oregon and is proposed in some of the East Coast states, you continue to see a pretty significant pull for renewable diesel. And as I said, the market for diesel in the United States is about 60 billion gallons. If you took every single soybean that's produced in the United States of America, everything that's used today for renewable diesel, everything that's used for food oils, every single soybean that's produced in the United States today, and turned it into renewable diesel, you could get 8 billion gallons. You could only cover 8 billion gallons of a 60 billion gallon market. Now the economics are clearly the challenge, but the market size clearly is not. In fact, California and New York combined together could use half of the soybean crop just in those 2 states. So you don't need a whole lot of states to participate in this mechanism in order to keep this demand keep coming. And as the chart on the left shows, some of the shaded lighter blue states is where we think that there's good movement towards an LCF to continue to contribute to the demand. On the right-hand side is just a listing of some of the plants. You'll see some in your backyard that are either just starting up or under construction, and others that are being built around the country. Bringing that to life on the feedstock gap, I'll clear this chart for you, but the top dotted line is the capacity to produce renewable diesel. That's in the refining business. They are ready to produce at that level if they just had enough soybean oil or distiller's corn oil or used cooking oil, whatever those different oils are that can go through those refineries to create renewable diesel. That's the capacity of that. The dark line is the current demand that is generated from the states on the previous slide that have an LCFS or have an LCFS, like in New York, in Connecticut, I believe it is, in Massachusetts. That is the amount that those states only can consume. It doesn't include those lighter blue states that might have an LCF sometime in the near future. And then on the bottom is the different feedstocks, and what we've done is stacked up where those expanding capabilities are coming from. You'll see that the dark blue bar is all these soybean processing plants that are either announced or under construction or planned to be constructed, and what those capacities can be. And so what you can see is there's clearly a huge gap between the capability in the refining business. There's a gap between the current states that we have good line of sight to consume renewable diesel. And so you will continue to see this pull on soybeans and canola for that matter as well, and all kinds of different oils to support that production. And so we continue to remain pretty friendly, this marketplace. This just shows where all the soybean crushing plants are, and it's the shaded in the background is where the soybeans are produced, and obviously that changes a little bit over time as soybeans become more and more in demand. And you can see there's a pretty good peppering of facilities. The facilities will remain in the growing regions, and then you'll ship the oil out. Clearly the advantage here is that the oil is a small portion of the overall seed, so you don't want to move the seed to a destination location, and then you want to have these soybean crushing plants where there's also animals, because meal will become a problem. And we'll talk about some of the things that we're doing about that. But production of meal, we just won't have enough animals. We're going to make more meal faster than what animals can possibly consume, and so therefore we're going to have to start exporting a whole lot more meal out of the United States. But you can see where the plants are today and where some of them are proposed. In full candor and transparency, it's been in the public domain that CHS is looking at a plant in southern Wisconsin, so you can see kind of a void of crushing in that area. So we've selected that area as a possible future expansion for CHS. I mentioned the U.S. configuration of oil. This just takes it out to a global nature, and you can just see how distorted the diesel market is and how big it is. And so we continue to be committed to our refining business. We recognize that regular fossil fuel diesel fuel will be around for a long period of time. These refineries can get converted over to, in part or in whole, to vegetable oils and make renewable diesel if and when an LCFS is appropriate in the areas in which you have those refineries. So far as with ours in Montana and Kansas, you didn't see those on the list of anything that we see in the near end. So we'll continue to provide regular diesel fuel and find a time in the future maybe to convert some of that into renewable diesel. But globally, there's just a huge gap to do this on a global nature. I gave you some of the numbers a moment ago about the United States, the 60 billion gallons of diesel fuel demand in the United States, the 25 billion gallons of demand of sustainable airline fuel, and every soybean in the country could only make 8 billion gallons. So it gives it kind of a bullish future. It's good to be in agriculture, I think. This demand pull will continue to happen, and with that, I think you'll continue to see another tier of prices going forward, and it'll be very supportive to prices. Which is why at CHS we continue to focus on our petroleum refineries, as I said, to continue to provide diesel fuel and get ready for the future there. We know how to crack molecules, so we know how to make diesel fuel out of soybean oil or other things. We're working hard in our ethanol plants to learn how to turn ethanol into sustainable airline fuel as well, so we're heavily engaged in that marketplace. We're in soybean crushing today and looking at making significant investments in the soybean crushing area because of what I've said about the demand profile that we see coming. And of course, canola is also a wonderful feedstock. It's got twice the oil content than soybeans does. We just don't grow enough canola in the United States. There's not enough areas of the country where you can really scale that production. So, but I do think, in this region in particular, canola will have a really strong demand and a great future. And I think as we continue to see, strong yield per acre, that's a great alternative. And we'll be looking at opportunities to expand our canola plant there in Hallock, Minnesota. So we're excited about that future. So what happens when the U.S. starts consuming more of these oil seeds and turning it into fuels? The world still needs soybeans. China in particular, still will be importing soybeans for cooking oils. That's the primary use of soybean oil in China. That demand I don't see just going away, which is also a great thing for demand out of the U.S. as well, because you're going to have a tightening of that supply and demand globally. But Brazil continues to really make significant strides in increasing their production capability. And as you can see from the chart in the top left, over the last 20 years or so, it's been a steady march of increased acres. And then the bottom chart on the left is a steady march on increased bushels per acre. And I think you will continue to see that trend happen. And frankly, the world will need it. So I don't want anyone to take away from this conversation that this is a real big problem. As I said, we're going to increase the demand for domestic consumption in the U.S., so there'll be great homes for soybeans. Frankly, there's not enough soybeans, as I've said, or won't be enough. And so the world will need soybeans. We'll need Brazil. But it is a direct competitor in the global marketplace and a huge determinant of what the price of soybeans is globally. And so it warrants paying a lot of attention to how fast this is progressing. Don talked a little bit about the weather in Brazil. Paying attention to production trends in Brazil is really important as we transition, because what we're talking about here this morning, is the next decade or so, and that trend. Brazil has also become the largest corn exporter recently. And one of the advantages that they have in Brazil, and it's really fascinating to see the soybean combines finishing up combining a soybean field, and on the other side of the field, the corn planters are already going. It's really fascinating to see that. So you get some real economic leverage out of double cropping corn and soybeans in Brazil, which, as you guys are all aware, is a pretty significant advantage on that acre for returns, and they can take a little bit lower price and still get tremendous revenue off of that acre. Now, that fact has also driven land prices up significantly in Brazil, and that is happening as well. But they've got more acres that they can put into production and continue to do so, albeit there's a lot of focus on not taking rainforest land anymore, but there's a tremendous amount of pasture land that can get converted. But the bushels per acre is also a big opportunity on a really, really big base. And so they've taken over the leadership role of corn and had a record corn crop this past year. And actually is going to, I think as we look forward, if we continue to produce corn as strongly as we do in the U.S., our carryout of corn continues to rise, and that's going to put some pressure on the global corn markets and on corn prices in general. And I think that's something that everyone should be very, very thoughtful about. This chart represents Brazil producing, on average, about 90 bushels of corn per acre. Now, the average in the U.S., I think this last year was about 173. So there's clearly some room for some technological advancements and some farming practice advancements in Brazil to raise that acreage, that bushels per acre, up significantly from 90, and that will allow them to continue to produce more corn as well. So things like ethanol to jet become that much more important for us, and things that we can, develop and advocate for. E15 becomes that much more important in this environment where you've got a significant competitor. I think as you look, the one that has been, as I said earlier, trending lower over the last 20 years is wheat production in the United States. Has clearly been losing out to the row crop economics, and I think you will continue to see that. The U.S. produces high quality wheats. We're the residual supplier of wheat to the world. Other areas of the world, like Russia, produce mass amounts of wheat at a much lower cost. Other areas of the world produce wheat at a lower cost. And over time, buyers around the world have increasingly used more of that wheat and less of U.S. wheat. And of course, U.S. wheat is higher priced, trying to compete for acres, and our own domestic consumption. So I think you see, wheat over time becoming more domestically driven, less export driven. And I say that with the caveat of quality, because quality wheats, like niche wheats, I call niche wheats like wheat and durum, have pretty inelastic demand, and there are some real quality attributes there that are highly desirable for those premium wheats. But that becomes a little bit smaller and smaller over time as price pressures and technology evolve, and new ways of producing some of those end products evolve. You see that continue to happen. So while I don't want the message to be the sky is falling on wheat, I'm clearly not trying to convey that, but the trend is clear. There's the U.S. wheat production over the last 20 years or so, and it continued to trend lower. We've actually saw, from a pricing perspective this past year, which I was completely shocked by, imports of wheat into the United States from someplace other than Canada. There was wheat coming from the Baltic into the coastlines of the United States in small quantities, but it still happened. And that over my time in 30 years in the industry, I've just not seen that happen. I think that just gives further evidence of the capability to produce mass amounts of cheaper priced wheat around the world, albeit lower quality wheats. It still works into many different products and many different blends, and we saw that happen for the first time. So it's definitely something to be thinking about in your production rotations. So what are we doing as CHS in this environment? And this is kind of the, put your money where your mouth is comment. On the screen, you see places around the world where CHS is operating today. We have an international business that's relatively small in comparison to what we do here in North America, but I consider it really important in getting that market access around the globe for all of you. We supply customers 12 months out of the year, and in order to do that and to be one of their preferred suppliers, be one of the tier 1 suppliers to customers around the world, and to know what they're doing and to be able to work with them on the alternatives that sometimes, hopefully many times, include products grown right here in the United States and exported out of the United States. We have to be able to do that year-round, and so the challenge for me in my role is to find that right balance of capability around the globe that accomplishes exactly that. So that includes expanding our business in South America, in Brazil in particular, As Brazil, as I said, continues to grow more of the soybeans and more of the corn and take more of the global share of the trade, CHS needs to be bigger in Brazil as well, larger in the Black Sea region, because those are significant supplies of corn and wheat to the world. And then some of you probably saw recently announcement in Australia where CHS is building an export facility in Geelong, there in the bottom of Australia and South Australia. And that is to export wheat out of Australia as another one of those alternatives to balance high-quality wheat demand across Asia with some of the high-quality wheat demand that we see coming out of North Dakota and Montana and Washington going off the U.S. PNW. So continuing to serve those customers year-round. So that's a really important component of our global business. I don't want anybody walking away from here thinking that we're not a U.S.-based and U.S.-focused cooperative, because, as I've said, and I want to make sure that I'm clear, we do the international business to support the largest and most important part of our business, which is North America, and our owners, who are North American farmers. So in that regard, this is a map of our export facilities. In the U.S. PNW, we are the #1 wheat exporter, #1 soybean exporter, corn exporter, #1 exporter off the U.S. PNW with those 3 facilities that you see. It's in a joint venture, a 50-50 joint venture with Cargill. We just added to that joint venture, Houston, Texas access. The facility in Houston, Texas, that was previously run exclusively by Cargill. We put it into our joint venture in Temco. And what the map is really trying to convey is the trade flows that come from these different areas of the country. And we can take spring wheat from northern Minnesota and North Dakota and go to the PNW and export it there, or we can ship those trains now down to Houston. And there's significant shifts that happen in the marketplace and capabilities there. The Panama Canal that I mentioned earlier changes some of the vessel freight spreads, and when that becomes really expensive to get through the Panama Canal, then the wheat should go to the US PNW. If it's really cheap to get freight at the Gulf, then maybe we ship it down here. So we have these capabilities, we have these options so that we can optimize the best price back here to the farm and to the acre and to your local operations. So that's been a significant achievement this last year in getting the Houston facility into the cooperative portfolio. We do corn down there, we do soybeans down there, hard red winter wheat, milo is a big one from the Midwest that goes through that facility. You heard Don talk a little bit about the Great Lakes system, and we've got the facility up in Superior, Wisconsin. It's been a legacy facility, good spring wheat, durum, sometimes even canola, going from this region of the country out through the Great Lakes system, which is really important as well. And then our Myrtle Grove, Louisiana facility is our Center Gulf facility, and this is where I've already talked about Temco, so I'll go right to the Myrtle Grove facility. This is where we are spending about $105 million right now on that facility to increase the capacity by 100 million bushels and also add capability for soybean meal and DDGs, other products that slow down our regular systems. And so we're putting in new capabilities that efficiently handle soybean meal in particular, because as I said, with all the increase in crush in the United States, we're going to have to clear that meal out of the country. So we even though you heard me say that we think that overall exports out of the U.S. will decline over time and the U.S. will lose share in the global trade due to that, we continue to invest in our export facilities because we think that trade is different. We think that the cooperative system is well positioned to support that. And we think it's really important capability to make sure that we are able to efficiently serve all of you. All right, I'm going to shift gears from grain and just talk just a little bit about fertilizer, because it's been kind of a crazy and bumpy road, and I want to one of the things that we can learn from history is what to pay attention to going forward. And I think the global urea prices is something that we can all learn from. And I wanted just to explain a little bit. In February of 2021, when Russia invaded the Ukraine, and then the gas got cut off or constrained, and natural gas from Russia basically supplies all of the natural gas for Europe. And so natural gas prices in Europe just exploded. They exploded to prices way, like 5 or 8 times the price of natural gas here in the United States. And it became just a flat out shortage of gas. Such a shortage that nitrogen production, which is based off of natural gas, was shut down in parts of Europe, just completely shut down, or just priced so astronomically high that it just couldn't compete anywhere in the world. And this is where we saw the huge spike in fertilizer prices, which none of us frankly like to see things get quite that crazy. But when you've got production being shut down around the world and there's a shortage due to that event, it made the production costs just unfathomable in some parts of the world. And of course that found its way back to the United States, because the United States is also an importer of urea, which I'll talk about in a moment. So paying attention to global events like that, I frankly didn't think at the outbreak of the war, my first thought wasn't, oh my God, urea prices are going to go nuts. That wasn't the first thing I thought of. But it's something that you should really, really pay attention to. I learned a lot about watching European natural gas prices relative to the U.S. because the global market drives disproportionate amount of the pricing power in the world. And so we really need to pay attention to events like that. Now, thankfully, that has resolved itself, and frankly, we sit here in a world today where it's actually a pretty nice day here in Grand Forks, and it's been a really nice fall, and the winter has been pretty mild, and natural gas prices are really, really cheap right now. So cost of production of urea, because of that, is pretty cheap, which is also something that we should all pay attention to, because it never really goes to zero now, does it? And so, it could be an interesting time to be paying attention to your urea needs. The other thing that happened during that very same period of time, you'll see the 21 and 22 chart on the left, where China exports. China is one of the more expensive cost of production areas for urea. They were constraining their exports at the exact same time as Russia was invading the Ukraine, and the natural gas was exploding and constraining production. So that was the perfect storm of activity that was happening. Then China decided to export some more, and that helped and contributed to the reset that we saw from $900 urea at NOLA in New Orleans down to what is today about $300. So it's about a third of the cost it was during that time frame. China is exporting more, and at the same time, India was importing less. So that also contributed in a pretty significant way to the price reset. So when you look at the cost of nitrogen across the three majors, urea, UAN, and ammonia, those prices have now normalized and have come closer together on $1 per pound of nitrogen, and become a little bit more in line with the historical price curves, albeit a little bit, resetting at just slightly higher levels than what you saw over the 25-year history here. At CHS, we've got this facility in Galveston, Texas, that we use to bring urea into the country. So we don't rely just on domestic production. So we'll import nearly 300,000 tons of urea in the port of Galveston. This facility we're spending about $26 million on over the next year and a half to double its capacity, basically, and that capacity isn't necessary 12 months out of the year, but you all know that when it comes time to farm and you want to pull the truck in and get urea put on the acre, you need it today, you need it right now, and we want to have that speed and that capability to make sure that we can get that to all the locations in a really timely fashion. So we're going to make a significant investment in that speed and capacity to make it get it to the interior quicker. That facility can serve all of these different points on the map and does serve all those points on the map, and you can see a pretty strong concentration up around us where we sit here today in this area. So I think it's a really important capability and a really important thing to have that ability to bring stuff in and from the global market as these markets can be pretty volatile. So we're really proud to be able to bring that capability to all of you. And maybe the last thing I'd say about the price is just to punctuate that natural gas prices currently are really at some of the historic lows. The cost of production is pretty low. Pressure is on commodities like corn, with exports out of the U.S. being constrained. So it's a delicate balance of making that decision, I know, between buying your fertilizer and getting that corn sold that makes sense. But I think if there's a direction of these markets, urea is relatively cheap, and corn would have some risk with good production and good seeding next year. To build more stocks and have more downside. So that would be kind of some high level thoughts I'd have at the moment. Obviously that all changes with weather and things like that. So as I wrap up with my prepared remarks, I know that we have the capability for some questions. If that's interesting, there's some mics around, and I'll open it up for any questions or anything else that you all would like to talk about this morning while we're here together.
You have an idea of the price of biodiesel versus renewable diesel per gallon? Probably not your department, but would you have an idea of the different costs for a purchaser of either one of them?
No, I don't know that I'd be able to say exactly the different costs of them. What I would say is that the mechanisms I referred to are in place and function to make it economically viable for those fuels to be an alternative on a price per gallon basis. But without those subsidies like an LCFS or a RIN or blenders tax credits, without that credit mechanism, it'd be really hard to convince anyone in this room or any other room to pay a premium for it just for the sake of having that claim. And so the cost of production of those items is more than a traditional fossil fuel, diesel fuel, and that's what needs to be solved, is how do we manage that over time? Question?
Will the rail capacity to get fertilizer up to this part of the world in light of the low Mississippi River flows, is that going to be adequate to fill the needs that we're going to have here in the spring?
Yeah, so the question, if you didn't hear it, is around rail capacity and being able to get fertilizer in place for all of you in the spring, with low river conditions. Basically, the fertilizer that would traditionally go up the river could be constrained. Today, drafts are constrained, and there are some areas of low water. We saw that last year, and that caused the problem, and that's the reason for your question, I'm sure. The one thing that is hard about the answer to that question for spring at this point in time is a lot can change in the river system quickly. The watershed of the Mississippi River draws across a huge portion of the country, and it doesn't take that much rain, quite frankly, to raise those river levels right back up again. We had a time last year we thought you weren't going to get any barges moving, and then all of a sudden we had a few rain events and back in business. But it is something that we're watching very carefully. We'll try to plan for that based on what we see and get inventories in position earlier and put them in the locations. Rail performance, knock on wood, has been pretty good. Obviously, the winter's been pretty mild, and a huge storm system can affect the railroad, and we've seen that happen over time, but we haven't seen any evidence of that. So I've got a high degree of confidence standing here today, but I'll refer you back to my first slide. Some of those forward-looking statements might not turn out to be true. Thanks for the question.
Last question over here.
Okay.
Don, I was just, your map showed, or CHS, member-owned. I was just wondering about, and this is a question you probably have been asked many times, the Odessa port, has that been damaged by, are you guys still shipping out of there right now?
Yeah, so the question is around Odessa, Ukraine, or maybe Ukraine in general. And we had a dot on the map there of Odessa because Odessa is the major port there, and we have historically gone through there. Just clarify for everyone that CHS doesn't own any infrastructure in the Ukraine. We only had put-through agreements at the port of Odessa. We do have employees in the Ukraine. I've got 28 employees in the Ukraine today. We continue to export grain out of the Ukraine, albeit at much lower levels than what we used to, because we've really constrained our activity in the Ukraine just because of the risk. We don't have a reason to try to run a port facility in Odessa or anyplace else in the Ukraine. We don't have that fixed asset concern, so we can step away. And we deploy our people focused on areas where we can bring it across the border into Romania. We're shipping grain down the Danube River from Ukraine to Costanza, Romania. And over the last couple of years, we've been able to export about 1 million tons of corn and wheat out of the Ukraine. That probably should have been 4 million tons that we would have normally done. So we're down 75% in our activity, and that's just due to the risk that is doing business in a war zone. So we stay pretty close to the borders, get it across the border quickly, get it to our facility in Romania, which is a NATO nation that we feel pretty confident in. But thanks for the question on Ukraine. It's been quite a journey for us in that. So. Well, again, thank you. I believe that was the last question that we'll take for today. We'll move on with the rest of the program. I want to thank you for being here today. Thank you for spending some time, and thank you for your business, and thank you for your support.